Afternoon, everyone. I'm Kyle. I'm the head FX dealer at FXOne. And I'm going to apologize in advance for using this. I just have a tendency to go on big tangents otherwise. So, yeah, let me get started. So we pretty much assist importers and exporters and wealthy individuals to navigate all things cross-border and essentially take over the Forex function of a business or an individual and sit between them and the bank. So we are generally able to do this service with the lowest spread than what the banks would offer them directly. But yeah, it really depends on the client. So I'll be speaking more to the imports and exports side of Forex rather than day trading, where we assist clients to hedge and protect their bottom lines. At FXOne, we do provide clients with the fundamental and technical tools to make their own currency decisions, but we believe that there comes a time when a line in the sand needs to be drawn. So I think that it is important to set some rules, especially in such a volatile rand environment with so many variables at play. Our clients have a direct interest in exchange rate, so as their Forex volumes go up, so does the need for them to manage that exposure. As we know, the rand moves a lot and can eat into profit margins at alarming speeds, so our focus is to bring about an average costed rate, which brings clients a peace of mind. Our concept is to find where goods have been costed when ordered and then try absolute best to limit any slippage on the exchange rate. This methodology, like any closer. How's that? Better. Is that better? Sure. How's that? Sure. So yeah, so like I was saying, this methodology, like any foreign exchange tactic, is not perfect. Although that being said, we often find that the final rate that our clients pay for goods ends up being better than what they would have got had they simply just bought the currency at a spot rate from a bank. So there are definitely some great structured and derivative products available at a premium, but we just try to keep risk management simple and effective. So from our side, clients often don't have the time or expertise to get involved in anything too complicated. And it's obviously important as well that clients know what they're doing when they get involved in something. So if something does go wrong, and the board's asking them to explain it, they can explain the logic behind it. So we found that the majority of our manufacturers in the sorts often prefer to focus on what they are doing rather than trying to understand more complicated hedging methods and that sort of thing. Our process is very client inclusive. We let them know everything that we're doing and often check with them that they're happy with their recommended policy before we actually put it into place. So this way, both parties are on the same page at all times. I'll get into the nitty-gritty of our model shortly, but I'm just going to touch on some exchange control limitations first, which are relatively boring, but unfortunately pretty important. So the first priority for us as a Forex intermediary is to remain in the good books of both SARB and FIC. Unfortunately, being light on the compliance side can very easily lead to big fines, which obviously doesn't appeal to us at all. A strong and knowledgeable FICA and compliance team has become essential in our game to stay on side and on top of FXOne regulations. So we've had it where a client hasn't submitted 1 out of 100 shipping documents over like 5 years old, and they get all of their local bank accounts frozen. So yeah, it's important to stay on side with FICA. You obviously can't provide a Forex service to a client who is non-compliant or who doesn't have their docs in order. So in this sense, it's key for us to guide companies through the extensive compliance side of cross-border transactions, which have heightened dramatically since we got grey listed. Our grey listing had a widespread impact, and I think we only need clearance on 1 or 2 more deliverables to be removed from that list, but that impact is expected to persist. When I say impact, I'm referring to our ever-inflating FICA and compliance requirements. How's that going? Sure, thanks, man. Is that better? Cool. So yeah, when I say impact, I'm referring to our ever-inflating FICA and compliance requirements as South Africans who have been grey listed. They've increased exponentially over the past few years. So all players who engage in cross-border transactions are now under enhanced scrutiny. You would have seen with crypto, any sort of trading, there's a lot more hoops to jump through, especially with respect to shareholding and source of funds. So from our side, this has slowed down both our onboarding and transaction settlement processes. We now need to go down far more rabbit holes than before to identify minority shareholders or, as an example. Settling payments inwards and outwards for any trader or any FX team has become far more strenuous for us, the client supplier, with exchange rulings being tightened so much. So obviously this doesn't fill our overseas trading partners with joy because they now need to jump through more hoops as well. If exchange control deems payment information insufficient, we then need to make an application directly to the SARB and wait for them to grant approval. And this just irritates everyone, comes at a cost of both time and money and causes a lot of frustration, but it is for a good purpose. So the other side of our compliance function is ensuring that supplier relationships are preserved by making sure that come value dates, exchange control will actually let a payment go through. And you wouldn't believe how often they say no once you've already booked the currency in and sent it through to them. So it's key to ensure that all ducks are in a row from a FICA and compliance perspective so that clients can actually pay and get money out the country when they want to. First and foremost, suppliers don't appreciate being paid late. Secondly, if we've booked a currency deal and an exchange rate has been set, the currency is now, the client's now in a currency position. So that currency either needs to be used that day at the set rate to make the payments, or the currency will not need to be sold back at the prevailing market rate. So essentially, if a client can't settle because exchange control aren't satisfied, they become wide open to cash flow losses, which is less than ideal. So let's say they bought the currency at 18, exchange control said no, they can't pay. They now have to sell it back at 17.90. So that's a 10-cent loss per unit of currency, which is, we avoid that at all costs. So from FXOne side, all of our exchange control expertise is sourced in-house. Thankfully, I don't have to do too much of that. And we use a powerful tool called KYCDD to streamline FICA flows and check with Home Affairs and make sure that we can operate. So while all of this is less than ideal, and as you can hear, I'm not very positive about it, the ultimate goal is to bottleneck illicit flows in and out of the country, and that's very much worthwhile. So if we are removed from the grey list, I think that these increased requirements will remain, but we should technically become more desirable for foreign investment, and this would hopefully result in more capital inflows, which would be awesome. So that's it from the compliance side. Once the client is compliant and has everything in order, then we start to apply our method. So at FXOne, we have a wide variety of clients, which we place at the different banks depending on client-specific requirements. And in return, we receive a thin spread on the currency from those banks, which we pass on to the clients. And this allows us to begin the hedging process with quite a thin spread and low transaction fees. We are in the business of protecting bottom lines and making an attempt to generate the best weighted average over the credit period afforded to our clients by their suppliers. So this obviously works both ways for importers and exporters, but I'm just going to continue to use importers to illustrate. So as a simple example, a customer has 90 days to pay $1 million. We then essentially have 90 days to do our job, which entails booking those dollars and using those dollars to make payments. Priority one is ensuring that we don't go over the client's costed exchange rate. It's critical. So this costed exchange rate is that line in the sand that I referred to earlier, and it's not possible 100% of the time. We have found that our method sets some rules and helps clients to feel comfortable. So like I was saying, if an importer has costed $1 million worth of goods at 19 Rand, mission critical is to ensure that the actual weighted average rate that we lock in doesn't exceed this 19 Rand level. To sidestep this risk, some customers choose to cost their goods at unreasonably high exchange rates. So for example, an importer might cost their dollars at 20 Rand to ensure that they don't incur a forex loss. This is a big safety net, but it can annoy customers if they happen to see a costing breakdown and puts pressure on the pricing of goods from the back end in any case. So there's undoubtedly a competitive advantage for companies who manage their forex efficiently and can keep the input prices down relative to other market participants. If they can avoid unwarranted forex rate slippage, margins are protected, and that's the idea. Certain importers might ask us for suggestions on which rate to cost at. We then just need to consider how tight the client's margins are and try to find some sort of balanced rate. This will change from one industry to the next. So as an example, logistics companies often have a lot less wiggle room in terms of margin as compared to certain retailers who charge massive margins at times. Again, we believe in holding close relationships with clients, so we'll take the time to understand their business model to be able to come up with a risk management strategy that suits them and specific to their needs and capabilities. So yeah, here's the nitty-gritty. After costed rate has been decided, the trigger tracker system comes into play. It's very uncomplicated, which our niche appreciates, and generally keeps the exchange rate in check. Let me stand this side. Briefly put, if a spot rate's at 18 Rand, which is the black line there, just near the top, we'll set a topside trigger at 18.20 and a bottom side tracker at 17.80. So now your worst case scenario is that red line, the costed exchange rate. And that's where if the Rand appreciates to 18.20, we cut our losses and we book. We'll pull the trigger, buy a percentage of currency, and hedge against the potential further move upwards. So the Rand has historically depreciated over the long term, and while you don't want to book at a topside trigger, this is where discipline and trading your plan comes into play. This is all in the name of safety with our currency, which is unfortunately very much volatile. On the other hand, if the Rand goes down and appreciates, we'll go through 17.80, and we now lower our worst case scenario from 18.20 to 18. Then we'll set a new bottom side tracker and try follow it down until it jumps one more time and we hit a top side again. So essentially your worst case scenario just keeps following down, and you give yourself a chance of catching any upside if the Rand does appreciate. But there's still that line in the sand that we keep in there. What importers want to avoid is a situation where they have no hedges and now they need to pay clients at unprofitable rates. So if you watched our exchange rate fly upwards in March and then you need to pay a supplier by the end of the month, your anxiety levels would have been through the roof. So we found that this method keeps average rates within a tangible band over the medium term and just keeps our clients from having to check the exchange rate every 5 minutes. So yeah, once we've booked some hedges, we put them into a client's mark to market, which is summarized here. So I know it is a lot of numbers, but it's as simple as I could have made it. So yeah, once you booked hedges, we put clients the amounts that they've booked versus what they owe. So you'll see that's hedged, that's unhedged, and that's a total. Using this model, we're able to map out a client's payment obligations over the foreseeable future. So I think this is like 3 months of they've got to pay $7 million. We input how much they owe the supplier, when they need to be paid, and then we also need to see, how much they've already hedged relative to what they need to pay. There are many different iterations of this report depending on clients' needs, but I've kept it simple just for ease of demonstration. Also don't have time to get into the different versions and inputs, but this is the output summary of a USD book. So yeah, this particularly popular tool is this 60,000 Rand here, the Rand per point. That's a calculation which shows exactly how many Rands are at stake. So it sort of helps people to give a tangible idea of actually if the rate moves from 18.26 to 18.25, then essentially the company's obligations become 60,000 Rand cheaper. And it's a lot easier, I think, for most clients to understand it like that. Otherwise, you're talking in dollars and it gets confusing. So yeah, it also influences how we go about hedging. So if a company has a large Rand per point exposure, we might just take a big percentage of the book off the table when rates are favorable or below the costed exchange rate, and then just de-risk completely. The remainder is then left to the trigger tracker model, and then we'll just see what we can leverage from that. Then in terms of tools and what we use, again, very basic. We are able to purchase currency, lock in an exchange rate, and then place into currency accounts for a 30-day period. The only downside being that you don't earn interest on foreign currency at most banks. So you'll forgo the interest you would have had you just left it in a ZAR account. We then also use and predominantly use forward exchange contracts, which are commonly known as FECs. And the FEC essentially just allows you to book an amount of currency for a future date at a fixed rate. So For instance, a company can purchase $1 million for the 1st of August, and they'll only need to pay their rands across on the 1st of August. They can then continue to earn interest on those rands until August. So with a strong financial history, companies can book an FEC without putting any margin down. And then for newer entities, you often have to put down 10% margin, which does earn interest, but obviously this brings cash flow and liquidity into play. FEC points are also something to consider. So the further out the date that you're booking for, the more you'll be charged per unit of currency. So, especially how the rate gets higher. So per month, it's about 4 cents for dollars, 6 cents for pounds, 8 cents for euros. And that's something to consider. Obviously, if you're booking 3 months in advance, your rate's going to go up by 15 cents before you've even booked. These forward points, I know for those of us who took ecos, those forward points are netted off against interest earned because you're able to hold onto the rands in an interest-bearing account. So you're paying forward points, but you're at least holding onto your rands until the value dates, and as opposed to paying for currency and then sticking into a currency account straight away. Forex exposure becomes slightly more complex when you have a company that imports and exports. They'll be paying out and receiving currency at the same time. But if you manage that effectively, it becomes a floating hedge. And then to wrap up, obviously I have to talk about the imperfections of the model. And there obviously are some, but again, FXOne focus is to protect clients from margin slippage. And we start them off by charging them a low spread on the currency, and then we take it from there. So this thing, there we go, sharp, thank you. Thanks. So limitations wise, credit limits and liquidity can be restrictive and need to be considered when we build a suitable risk management process. So depending on financials, a bank might protect themselves by only allowing a company to book a certain amount of currency at one time. This stands as a limitation on how much forward cover an entity can then take out. Then, like I was saying earlier, depending on the company's financials, a bank might say you need to put 10% margin down before you can hedge anything. So then you've got to consider cash flow and liquidity. And you'd be surprised with how much of a constraint that can be for certain importers who rely on quite a tight liquid flow. Particular attention also needs to be paid to big economic data releases like CPI or interest rate announcements. There's often times when there's an important data print due where the market is unsure of what will be announced. And these are big days for us because those decisions can influence the currency dramatically. So we pay special attention to those days when there's a heap of uncertainty. An easy example would be interest rate decisions. There could be an estimated 50% chance of the SARB increasing interest rates. Now, I'm not into 50-50s, so we'll often issue a trade recommendation to take off some percentage of the Forex book before that announcement is made. This just protects clients from massive blowouts, which we see all the time, where the currency spikes so quickly that orders might not get filled at the required level. So the actual amount to be booked prior to the decision is determined by liquidity, credit terms, the client's risk appetite. We take that all into consideration. So on these days, we step away from the usual trigger tracker methodology because the rand is susceptible to such massive swings in short periods of time. The trigger tracker method handles random events like when the gold price begins to slip or one of our politicians says something silly, but we found that it's often best to remove some exposure before these big coin flip announcements. So yeah, ultimately, this is a method which works for our clients and provides them with more time to focus on what they want to do by taking away that foreign exchange headache completely. So yeah, again, very granular overview, but thank you very much, everyone, and yeah, all the best for the rest of the week. Thank you.